Hello and welcome to the DIY Investing YouTube channel. We are covering every company in the S&P 500, but today we're covering Solitron Devices, and I'm super excited to cover Solitron Devices. This is not your normal 10-minute review. This is going to be a deep dive into Solitron Devices, ticker SODI. This is a stock that I own. This is the biggest company currently in my portfolio today here in October 2023, and I am super excited to discuss it with you today. I did a video on Solitron Devices 2 to 2.5 years ago. This was episode 114 of my podcast, so you can find this both in the audio only format or in the YouTube channel, podcast episode 114. I will discuss that thesis today and then update it from 2021 to 2023. And this is my second recording of this video. I've recorded almost an hour-long version of this video, and at the end of it, the audio was lost. I had none of it, so I'm going to try it again now, and hopefully this will be a little bit quicker. I'm going to be a little bit more succinct as a second go-around, so we're going to go at it. Now, Solitron Devices is a stock that I own. That is my disclosure here. I do own the stock. I would, of course, profit if the stock price goes up, so I have that incentive. Of course, as a net buyer of the company, I've never sold a share. I also benefit from if the shares are down in price and I'm able to buy more. So no caveats. I'm certainly open to selling any day, buying any day. I give no predictions of how I will handle the stock in the future, but what I want to do in this video is discuss the fundamentals of this business, what I think of my previous estimates from 2 years ago. I'm going to update that thesis to today, and I think covering it will be very beneficial for you. And for me to really get my mind straight about this business. So I hope I can provide that to you in a really good detail. We are going to cover this thesis from 2.5 years ago, and I'm going to touch about each of these points. The beginning of this, in 2021, we had the stock price of $7.25. The current price is now $11.40. It's between 11 and 12. It's been bouncing around there now in October 2023. The underlying earnings power, my estimate in 2021 was $1 per share with a trailing 12 months of about 60 cents. I thought it was a high-quality business in a non-cyclical defense industry, double-digit revenue and earnings growth, large operating leverage. It had a skilled management team focused on shareholder-friendly capital allocation, and $1.50 per share in net cash. Now, as we think about this thesis from 2021, again, this was 2.5 years ago, I think this has turned out to be very, very good. This is a very strong thesis, and we can see that it's worked out very well for me as a shareholder. I owned the stock then. I own it today. I have bought shares since then, and I don't believe I've sold a single share during that time period over the course of that period. So at the time, the share price was $7.25. Over the past 2 years, it is now $11.40. So we can see that it's up over 50% over the course of a 2-year period, which is, of course, averaging over 20% per year compound growth. That's a very good return to me as a shareholder. There's been, of course, no dividends during that time period, so the only benefit has been capital appreciation. Likewise, when we look at underlying earnings power, I estimated $1 per share in 2021. If I were to make an estimate today, my current estimate of earnings power would be between $2 and $2.50 per share of what I think they're capable of earning today as a company. Now, on a trailing 12-month basis, their earnings are basically zero. They're basically flat, actually. So the trailing 12-month picture today is worse than it was 2 years ago, and we'll talk about why that is and why I don't think that's a good reflection of their underlying earnings power in this video. Now, I said it was a high-quality business with a non-cyclical defense industry. I believe that is still true. I do believe this is a high-quality business. It's in the defense industry, and they've actually bought a new subsidiary that's in the medical device industry. But the defense industry is particularly attractive, more attractive today in 2023 than it was in 2021. Over the last 2 years, we've had a big change. There is now a war in Europe between Ukraine and Russia, and just in the past couple of weeks, it looks like war might be breaking out in the Middle East. We don't know how that might play in terms of the defense industry. Unlike the United States' European allies, Israel doesn't have as many programs in terms of reliance on U.S. supplied materials like some of our European allies do. And so they have a lot more of a homegrown defense industry. So I don't know if that'll actually make any difference for Solitron Devices as a company. We've seen foreign sales to Europe from Solitron Devices. I don't believe we have any foreign sales to the Middle East, but it's just something to think about in terms of the overall defense picture. Is you have in that last 2 years, more European companies, more European governments are deciding to increase their defense spending, and that is definitely a tailwind for the defense industry. There's also been announcements in the U.S. about stockpiling and such, and we'll cover that. All big tailwinds both for our company and the defense industry. Now, I thought it was double-digit revenue and earnings growth. That was both right and wrong, and we'll cover those details there. And I still think it's going to be double-digit revenue and earnings growth going forward with all the details the rest of the video. Large operating leverage, still believe that's true. Skilled management focused on shareholder-friendly capital allocation. I did not realize how true that was, but I have some great examples to cover in the video. And $1.50 share in net cash. That's the only one that's still not true today. They've actually used their cash to buy a business that adds to their earnings power, but of course that means the cash isn't there anymore. So they spent the cash, but I think the business is even better and more attractive today at $11.40 than it probably was back when it was $7.25 2 years ago, and we're going to dive into those numbers. So now, again, trading today, $11.40, about 11 to 12 is where it's been bouncing around recently. Don't pigeonhole too much on the specific numbers. So we're going to look at some of the financials here, and I think this is a great place to start. So when I was looking at the company in 2021, this was my trailing financials. I had total revenue, $10.5 billion. It had grown over from the $9.2 billion. So you can see that double-digit revenue growth, 9.2 to 10.5. Over 10% growth. And that's what I was looking at. I was like, hey, this business is going to continue growing at double digits. And they did. They grew even faster than I expected, $12.2 billion from 2021 to 2022. Now, that was important, and you can see that they fell off significantly in 2023, and there's good explanations for why this happened. And I think it's a key thing that we need to understand today because it impacts all of these last 2 years. There's been a lot of changes in the underlying business that really matter for us. So when I said before you had $1 in earnings per share is my estimate, that meant that I expected them to earn $2 or $2 million, on an earnings basis, basically on the bottom line. So on a trailing basis, they had been earning about a $1 billion, 1.3 million. I thought their earnings power was about $2 million. They have about 2 million shares outstanding. So that's why that matches out, to work out to about $1 per share. So now, I think that was a very solid estimate of the overall sustainable earnings. That's why I really liked using that number in 2021. I thought that was a really good description, about $10.5 million in total revenue. Now, they grew significantly in 2022. Now, why did they do that? Well, one of the things they did after I made this video that I thought was very attractive was in 2020, actually, I can't remember the exact date, but one of the things management chose to do to allocate their capital was they moved the production facility from a big facility in Florida to a smaller facility in the same town. And what they also went from leasing a facility where they paid a very large amount of rent, I think it was something like $400,000 a year, $500,000, $400 to $500,000 a year in rent, and that was escalating each and every year. But they bought a facility of their own that they would own with a mortgage, with a fixed rate, and their estimation at the time when they were doing that was that they would be able to save $1 million per year in expenses by making that move. So that was actually really incredible because you think about what is the benefit of $1 million to a company of this size? Well, $1 million is equivalent to about 50 cents per share in EPS. Again, about 2 million shares outstanding, 2.08 million shares is I think the current amount. So I'm just, doing some quick math. It's a little bit less, somewhere between 40 to 50 cents per share in EPS from that program of moving the business. So on that alone, you can say, hey, that's going to increase our net income by about $1 million, all else equal. And I do think that is a good way of thinking about it. So they made that move. Now, what did they have to do to execute that move? And that's what shows up here in 2023 and 2022. That's the story of the last 2 years. Over the last 2 years, management has been making this business better by moving facilities. So they moved from a very large, expensive facility to a smaller facility that they owned. They fixed their basically expenses, because now they have a mortgage. I believe the mortgage is under a 4% interest rate, very attractive interest rate. And they got rid of all their rent experiences. They lowered utilities, everything along those lines to get to that $1 million a year in savings. And that's leading to a reduction in some of these expenses. So that's a really good sign there. But what they had to do was in 2022, they increased their revenue and their sales in the short term, and they ended up decreasing it in 2023 because before they moved, they produced a lot of extra material so that they could sell it while they were moving facilities. Because when you're moving facilities, you can't produce product. You're going to have to move your people from one place to another. They're going to have to take down the equipment, set it up in a new location. All of that takes a lot of time. It's expensive. So you have a lot of one-time expenses during this period, and you have a lot of lost potential sales. But partially, not just lost sales, but distorted sales because they had to increase this number faster than it otherwise would. And then for a few quarters in 2023, they had substantially lower sales than you would have expected. So those things together just massively destroyed the financials here in a way that it's not a bad result, but it doesn't look normal. It looks like, hey, you're growing double digits, everything looks hunky-dory, and then you had like a 40 to 50% drop in revenue. What happened? Like, it looks like the business just fell apart. The business did not fall apart. This was an intentional move, and what will show up in the future is this number is going to be abnormal. 2023's annual earnings is not normal. This loss of operating income is not normal. You're not going to see that going forward, but it's not yet shown up in the business. This is the last full year. So you're sitting here at $11.25 EPS on a business, and it's just not showing up as a normal number. So that's going to be hard to really make sense of if you're an outside shareholder, if you're not really paying attention, if you don't know what's going on. This company will screen very badly right now, but I don't think it'll screen badly in the next 12 months, and that's going to be for what we cover the rest of this video. So that's just something to be aware of here is this growth was a little bit abnormal. The sustainable sales probably in 2022 was something like $10.5 to $11 million in sales, but they sold more than that, and they ended up selling yes in 2023, and now we're done with the move. So the move has been completed. The company has reported in their annual meeting and in other releases like, hey, we're on track. We're earning what we think from this move. So we think we're going to end up saving the $1 million. I don't remember the exact wording from that meeting, but you can, of course, see it on their website. They have these last two annual meetings. I highly encourage checking these videos out to show the discussions from management about the underlying performance of the business, the strategy. It really breaks down what they're doing. But the main thing is that covers a whole lot of information. But, one of the statements in there is talking about this program, why they made the move. It was a big part of it. And I believe at least by the second one, they'd already completed the move. And so this move is done. The savings are there in the business. They're just not yet shown up in the financials, but they will be going forward. So that's something very, very important. When I think about 2.5 years ago when I made this previous video, this was not on the horizon, but now it is. It needs to be updated in your thesis. It's one of the reasons we've gone from $1 in earnings power to $2 to $2.50. So very key there, very key to understand. I don't think this 2023 number is realistic. I don't think it's representative of the business, but the market doesn't know it yet. And that's where I think there's an opportunity in the market today. It's what I think shows, somewhat of an informational advantage in the sense this is all public information. This is what shows up on a screener, but we're going to go through public press releases that show the other information out there of how the earnings power of this business is actually much stronger. So let's touch on some of the other pieces here. High quality business. Why do I think it's a high quality business? Anytime you're getting your business from like the government, the defense industry, it's very stable, reliable orders. It's very hard to steal business from. So that's still all true. I already talked about the tailwinds of the defense industry. Double-digit revenue and earnings growth. I think that can be achieved. That's difficult, but we're going to touch on some key pieces in here. Large operating leverage. So let's touch on that for a second. So I had a theory with these numbers that there was going to be large operating leverage. You could see when you went from 2020 to 2021 that they were able to grow their revenue while reducing their cost of goods sold. That was a very good sign that they could see a big increase in gross profit. Gross profit increases lead to good operating leverage. They didn't have to increase their SG&A much to do that, so very good signs. So that was my theory. And then in 2022, we had a great example of this working. They increased their revenue by $1.7 million. from 10.5 million to 12.2 million. But the actual cost of the revenue, the cost of goods sold, only went up $230,000. So that's a really key thing. The incremental margins on additional revenue are substantially higher than the gross margins on the existing business. So as they grow the business, a lot of that money is going to drop to gross profit and drop down to the bottom line. So this is a key ingredient for high outperformance on a stock, is when a business can use operating leverage. And this operating leverage shows up right here. You can see it. You can see it in the numbers going from 2021 to 2022. That's a key thing. So it shows my theory from the previous video is accurate. The problem is you need growth for that to show up. The same, everything falls apart if you don't grow. And so you see the opposite in 2023. As the sales shrink, you went all the way down to a loss because you can't cut expenses at the same rate. It has this strong fixed cost. Those fixed costs are great on growth and very bad on when you don't grow and when you're actually shrinking. And so you get both sides. Operating leverage can be very good or very bad. I think it's going to be very good in the future, but obviously over the last year, it's been very bad. Now, this is important because what I'm going to show over the rest of the video is how this operating leverage can be turbocharged with our future growth. So where do we go from here? Skilled management, focus on shareholder capital friendly allocation. So shareholder friendly capital allocation. So one of the things they did was, of course, moving the facility. They've done a second thing. They just completed a purchase of a new subsidiary. And this is really important. So we can see, we're going to go through some press releases here. So the first press release, this was back in June or July of 2023. They announced that on June 1st, they signed a term sheet for an acquisition of target company. This is in the medical industry. It would have an initial payment of $3 million and earnout payments of $450,000 for 3 years. So basically, total purchase price is about $4.5 million. At the time, they thought revenue was about $5.9 million in 2022, $5.5 million in 2021. So, can't guarantee the transaction would close or anything like that. But fast forward to September 1st. In September, they closed on their acquisition of a new subsidiary, which is Microengineering in Apopka, Florida. So Solitron already exists in Florida. This is now a second facility in Florida that Solitron will own under the Microengineering subsidiary. So this is really key. Again, they paid $3 million. They purchased it with cash. So this is not a stock. There's no dilution here. And they're paying $3 million in cash up front and 7.5% of annual revenue for 3 years. Now, that means basically 36 months. But of course, it's not going to align with the with the calendar year. But 36 months, they're going to pay 7.5% of annual revenue. So it's approximately $450,000 a year if your revenue matches 2022 revenue. It could be higher if it's higher revenue. You certainly want it to be higher. But if you just assume it's 450 times 3, you're going to be about another 1.5 million. Total purchase price, about $4.5 million. So what do we get for $4.5 million? For $4.5 million, we are purchasing a business that has $5.9 million in revenue for 2022, 5.5 in 2021, so they were growing, and operating income of $1.3 million in 2022 and $1.2 million in 2021. This is key. This is very important. Why? It's important because they spent about 4 times earnings to buy this business. So if you earned $1.3 million in operating income, maybe that means you earned about $1.1 million, $1 million or something like that in net income on this business. So after taxes, we're talking about, 4 times earnings, 4, maybe 5 times earnings. Call it 5 times earnings. We just bought new earnings at 5 times earnings. That's incredible. That's a very good price. Now, why was it so cheap? It's because one customer is about 90% of revenues. It's a very risky thing to do when you have a business like this. But it diversifies us because now we're no longer a defense industry only. It's now 60% of business is defense and 40% is now in the medical device industry. So that actually helps us a lot in terms of diversification. But when you think about these revenue, it's actually really interesting what we've done here, though. I'm going to take this number here, right? Revenue for 2022. 5.9 million. Let's round it up to 6. Call it 6. That means about 1.5 million per quarter. So now we're going to go back to these financials. And I'm going to show you where if you look at these quarterly results, how things have changed. And you can see here are the last 5 quarters. So we just ended the September 2023 quarter, $2.5 million in revenue. you can see the move, right? So you had 2 million in revenue a year ago, 2.1 million in revenue a year ago. And then when you moved in this November quarter, right, you had substantially reduced revenue, only 500 million. And it slowly started to ramp up again. You're at 1.5 million, 2 million, 2.5 million. So we fully recovered and we're back to more of a normal revenue for this last quarter. So we have 1 quarter of a normal revenue, which is 2.5 million. If you do that 4 quarters, you say, hey, this is about a 10 million business. Again, annually, that's what we were doing in 2021. That's probably around our sustainable business. Around $10 million was the sustainable point for Legacy Solitron. But we just purchased an additional, 5.9 million, which is 1.5 million a quarter, assuming it's all even. It's probably not even. Maybe it is, maybe it isn't. I don't know. But now we're going to go to about $4 million in revenue per quarter. So historically, we were averaging 10 million, 11 million. That was like what I would call a sustainable number. And we're adding 6 million a year to that. So now we're going to be at 4 million a quarter, 16 million a year in revenue for this business. That's a 50 to 60% increase in the sustainable revenue rate for this business. That's incredible. That's very, very good for the future performance of our business because we have operating leverage involved. Now, the operating leverage I've talked about that we've seen, that's all legacy Solitron. So we're not going to see it in that sense, right? Microengineering is not going to help the cost of goods sold for Solitron's products. What it might help is some of this SG&A cost. Some of this SG&A cost is due to being public. So running a public company is expensive, and it's particularly expensive for very small companies compared to their size. So you have a business like this, and maybe it costs you $200,000, $300,000, $400,000, $500,000, somewhere in the $200,000 to $500,000 range to be public as a business for Solitron. So for a small business like this, and you look at your total SG&A, I mean, you're talking somewhere between 10 to 20% or 10 to 25% of the total SG&A for a year might simply be because the company is public. And they have public expenses. You got to pay board members. You got to pay filing fees. You got to put out press releases. You got to pay fees to go, send stuff to the SEC. You have to have auditors. You have to have all sorts of stuff that goes with being public that is not true if you're not public. So this is important to have this acquisition because although you won't see operating leverage from it on the gross profit line, you'll see a little bit of operating leverage on the SG&A line because now we're splitting our public expenses against an additional 6 million in revenue that you wouldn't have had otherwise. So that's a very good sign for Solitron. The more of these acquisitions we can do, the more we can dilute the public expenses for being public. And we really need to get away from zero for a business like this to really justify being public. It's hard for companies in the US today with all the expenses, all the regulation to stay public as a $20 million business. You'd much rather be a $50 million business, $100 million, $200 million business where it starts to make sense. At 20, 25 million, it doesn't make as much sense. So I'm really excited that this should give us the trajectory to get to something like a $50 million market cap. Start pushing towards a $100 million market cap where you can start to justify those expenses that I'm glad they're paying because it's public, I can buy shares, but it's hard to justify it. So we have that piece. Now, what this does though, is providing us, again, they purchased this company, this operating income. This operating income is incredible because, look, we're going to go down here to these financials, okay? So this is our 2021, 2022, and 2023 financials for the new subsidiary. So you got sales, expenses, operating income. Now they have PPP loan forgiveness, so we're going to ignore everything below this number because it's not accurate, because we don't have any more loan forgiveness. So really, this is where our numbers stop. And you think about this, that is an incredible amount of money to add to this business. This is an additional $1 million potentially in net income for the business, which is again about 50 cents per share in earnings. So now we can see very quickly how we get to my estimate here. So in 2 years ago, I said my estimate was $1 per share. I add 50 cents because of the move. I add 50 cents because of the new subsidiary, and I'm adding somewhere, but maybe another 50 cents due to some operating leverage and some growth that's happened over the course of those few years. So that's where I'm going, somewhere between $2 and $2.50 per share. Or if I translate it into overall earnings, that's $4 million to $5 million in earnings power on a current earnings power basis for this business. Because I see, when I'm looking at this business over the next 12 months, I'm not looking saying, hey, what's this number going to say for fiscal year 2024? That's not what I'm talking about. I'm talking about from today, sitting here in October 2023, what does this business look like in 2024 October? In October 2024, I think we're going to look back over the last 12 months, over this coming 12-month period, and say, this business is earning about $4 million, maybe $5 million per year. $2 to $2.50 per share. $2 per share means this business is trading at somewhere between 5 to 6 times earnings. That's kind of where I'm thinking this business trades at today. 5 to 6 times earnings. Now, on a trailing basis, it's earned nothing. It's basically zero. I can't remember if it's like positive a penny or negative 10 cents, negative 5 cents. I don't know. But it's basically break even or nothing over the last 12 months. But I'm talking the next 12 months. You buy for the future. You don't buy for the past. The past is all the stuff we've talked about. But the future is going to be substantially better, in my view, in my opinion, in my analysis, than I think the past has been. And it's not yet showing up on these financials. And it will if these things hold true. So we've bought that business. Now, where does this get exciting? It all comes back to then operating leverage and further growth. We've seen how you go from 10 million in revenue to 16 million because we're adding that extra 6 million to what was a 10 to $11 million business. So that gets us to 16 million in revenue. Now, let's go back and look at what else they've announced. On these same announcements that they made about the initial acquisition back in June or July, they said, hey, we have a stockpile program. So in December 2022, the President of the United States signed this omnibus bill, $1.7 trillion. And that included two of the Solitron's largest revenue sources. And so what they expect is an additional $20 million in revenues starting in late calendar 2024, running through 2028. So for 5 years, they expect an additional $4 million in annual revenue. Actual contract awards expected to occur in fall of 2024. That might be October 2024. That's a year from now. So we're saying, hey, a year from now, maybe we're looking back at a business that's earned 16 million in revenue, maybe 4 million in profit. Nice, solid 25% margin. And then you add an additional 4 million of that. So then if we go forward 24 months and we say, we're sitting here in October 2025, what do we have? Well, now we add an additional 4 million in revenue and say, maybe we have a $20 million business. So instead of a $10 million revenue business, sitting in October 2025, when I make another video 2 years from now, maybe we're at $20 million in revenue. And I don't even know what the profit might look like on that incremental 4 million in orders. But perhaps that takes us from 4 to 5 million in profits up to 6 million in profits. I don't know. I don't know what that operating leverage is going to look like. I don't know what the gross margins are going to look like on that business. There's no insight given to us on that. But we can clearly see a path simply based upon public press releases to get us to 20 million in revenue, which is 2 times higher than what we had before September 1st, before this purchase went through. That's incredible. So you're seeing almost a doubling in revenue over the next 2 years, or a tripling from what we reported in 2023. So revenue might triple over the next 2 years from what was reported in 2023. And this is just what's been announced. And then in September, when they made this announcement, they said, hey, on top of that 4 million, the United States, we've seen news reports that the U.S. has agreed to military sales to foreign countries that include programs that Solitron supplies. If they're approved, because they're not yet approved by Congress, we expect additional orders of 2 to 3 million in the next 12 to 24 months. Now, I don't know if this is a one-time order, if this is the start of recurring orders to the foreign countries. I'm assuming they're to Europe, to NATO, probably based upon the Ukraine war taking place, probably based upon NATO starting to spend more money. But if that's true, here's even more money. So maybe 2 years from now, we're looking at this, again, 12 to 24 months. And instead of 20 million in revenue, you see 22 million, 23 million in revenue. So there's a clear path simply from what's been announced so far for Solitron Devices to increase the revenue from the trailing number of 6.4 million to 22 or 23 million dollars within the next 2 to 3 years. Just on announced press releases, just from the announced acquisitions. It's all out here publicly, but it's not showing in these trailing numbers. And it's one of the things that makes me super confident about investing in Solitron and for it to be my largest current position. Again, I own shares in this company. What makes me even more confident is what just came out in the news this week that prompted me to make this video today and update my thesis. And that is management believes in this stock enough to buy 3% more of the company at market prices. So just this week, so we have October 16th, they've announced the CEO, Tim Erickson, buying 35,000 additional shares. That's about 1.5% of the overall company at $10.70 is what he paid for those shares. The Chief Operating Officer, COO, Mark Matson, who runs the production, bought an additional 19,000 shares. That's almost, but a little under 1% of the outstanding company. And he adds that to the shares he already owned at $10.70 per share. All of these shares are coming from a fund that is liquidating, and this is here in this one here. And so the chairman of the board is one of the people that runs that fund, and in the liquidation of the fund, he chose to keep his shares instead of taking cash. And those are valued, of course, at $10.70 per share, adding them to his own holdings of the company. So now he owns more, or he owns, close to 1.5% of the company. And so all of this together is about 3% of the company moving from a fund that is being liquidated into the hands of the chairman of the board, the CEO, and the chief operating officer. They're buying at market prices. And that's very attractive because what they're saying is, this company is attractive at $10.70. We've put out attractive press releases. We've saved $1 million in expenses. We've told you about that. We've bought a company that's earning $1 million in profit. We've told you about that. We have announced $4 million per year coming from a multi-year program that's starting in a year. We've announced an additional $2 to $3 million that might start in a year or two that, not approved yet, but it could come. And we're making public that we are buying shares in the open market. All of this says to me, this company is attractive. It's something that becomes really interesting. And it makes me extremely confident as a shareholder in Solitron Devices about the future. Again, I own stock in Solitron. Do your own work. Do your own due diligence. This is not investing advice. I'm not recommending you look at this company or even research this company or even do any of that. You should do your own research before buying any investment and get financial advice from people that can recommend it to you, which is not me. But I own this company and it's my largest stock. And I wanted to update my thesis because I put one out 2 to 2.5 years ago, and it has worked out extremely well for me so far. And I continue to hold shares today, and I'm excited about the future. And I think today is a really unique time because when I look at it today, I see a company that is reporting losses in their trailing numbers. But going forward, they have already accomplished a savings program. They've already closed on a new acquisition. They've already announced future sales that should come in over the next year or two. And none of those things show up on the financials yet. None of those things show up on a screener. But I think once they do, the stock price is probably not going to be at 5 to 6 times earnings. So that's my thesis today. That's my thesis in October 2023. I look forward to updating this 2 years from now to see what more exciting things the company has done. I mean, you start to think about the one other thing this company has done. If you think about if this comes true, if they earn $4 million over the next year, $6 million in the year after that, which is what these numbers would actually, now you have $10 million in cash. They just spent $5 million in cash to buy $1 million in profits. Can they spend that $10 million in cash to buy $2 more million in profit? Go from $6 million to $8 million? I mean, there's all sorts of upside here that could happen. I have no expectation of it. I have no idea if that could happen, but just the simple possibility that in a few years, we can go from a company that's reporting losses to a company that's reporting $4 million, $6 million, $8 million type profits on 20 million plus in revenue is extremely exciting. So I trust management to manage my company with this money. They are putting their money where their mouth is, and so I'm super excited about the future. Thank you for listening. If you learned something, hit that like button. Don't forget to subscribe. Do your own research before making any investments. Do your own due diligence. If you're interested in this company, research it, follow up on everything, do all your own work. I hope you've enjoyed it. Thank you for listening. Until next time, stop paying fees, start building wealth.